Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, May 29th, 2024 edition of Trading Places live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next, maybe 20 minutes or so as we prepare for the market open. I do want to apologize for that delay at the open. We just had some technological issues with our software, so we had to do some troubleshooting, so I apologize for that. But we're going to jump right in and get going because we don't have a whole lot of time. I'll try to still cut it off right at about the time we open the market. So let's take a look at what happened yesterday. First, you can see that the Dow Jones Industrial Average, if I zoom in here for you, fell again yesterday, down 217 points, back to 38,852. That was a close actually below the 50-day moving average. So since gapping up, moving above it at the beginning of May, come back down, and we've pretty much gone full circle back down just below that 50-day moving average. So that'll be something to watch. We've got gap support. And of course, the big low, in my view, would be that May low. We've been coming up higher highs, higher lows. So we want to keep that low in play. That would be down closer to about 37.6. So we do have a little bit of room to the downside for this period of what could be consolidation. And I'm talking about, this is a slightly higher high, possibly come back down, test these lows, and then have this sideways rectangular type of consolidation. That's certainly a possibility here on the Dow. The S&P 500, though, was up a point and still looks like it's in an uptrend with a bull flag, a little flag out here to the side. So really two different markets when we look at the Dow and the S&P 500. Moving on to the NASDAQ, we have a third market, the one that just keeps going up, which is the NASDAQ 100. Big day yesterday in semiconductors, which certainly helped this index, but the NASDAQ 100 of the NDX gained 61 points. That was about 1/3 of 1%, continued moving to new highs. Then we had the mid caps down 19. That was down almost 2/3 of 1%. Back to test its 50-day moving average, literally almost sitting right on the 50-day moving average. We're 4 points above it. The IWM, rough day yesterday. We saw that 10-year Treasury yield pick back up again. And as a result, IWM fell, went back into negative territory after gapping up earlier in the day. The IWM finished down 25 cents to 205.19. That was down about 1/10 of 1%. And what else is new? Transport's down 88 points. That was down almost 6/10 of 1%. And this group is down, challenging the lows that we saw in the middle part of April and then also at the beginning of May. So still got a little bit of room to the downside, but not as much as we see on many of the other indices. The Dow transports continue to be weak on an absolute basis and certainly on a relative basis. Energy, we're going to finally see the energy group picking back up. I don't know, but we do have a pattern of lower lows and lower highs that are in play. We did finally see crude oil prices jump yesterday, and as a result, we saw the XLE also jump a little bit more than 1%. I would say first off, I'd be watching the 20-day moving average. But quite honestly, I think the 20-day all the way up to the recent high, I think that's the area of resistance you're going to be looking at here for at least the near term until we can get through it. So I'm going to say about 93.25 up to maybe around that 95 level. If we can get a close back up above 95, this could start to look more like a cup as opposed to a downtrend or a channel to the downside. So that's what I'd be looking for there. Technology, second best performer yesterday, mostly because of that semiconductor group, but technology continued to move higher. And that's one of the reasons why we saw the NDX outperform yesterday. Technology was up almost 0.5 of 1%. Communication services up 0.2 of 1%. Still sitting in this maybe cup, looks a little bit like a cup, not exactly rounded. I would have expected a little bit more slowly moving higher from this bottom back up, more rounded. But anyhow, it is a top. We have a lower low in play, and then we have a double top coming in here on the right side. Probably would like to see a little bit more volume on the right side of a cup. That's normally what you look for. Not really seeing that here with the XLC. So definitely some mixed signals, but there's no mixed signal as far as what the resistance level is. It's right at about $84. And that goes back not just on this chart, this 6-month chart, but goes back a few years. If you zoom out, actually, let's take a look at that. XLC will go out Let's do a 5-year weekly chart. And here you can see back in 2021, prior to that 2022 cyclical bear market, we had gone up just about to that 84 level, just shy of 85. That's what we're looking at here. So not only the double top that we're looking at just from the past 5, 6, 7 weeks, but also this stretches all the way back to a key resistance back in August, late August 2021. All right, move back into that candle glance. Let's look at non-ferrous metals. This is the industry groups that were leading yesterday. The first non-ferrous metals, 717.40. That was a jump of 28.09, which is a little bit more than 4%, bouncing off of this kind of trend channel, uptrend line, 20-day moving average, whatever you fancy. But we did make a nice 4% jump yesterday, and now moving up possibly to threaten the high that we saw just a couple weeks ago, maybe a week and a half ago. Semiconductors, there they are, jumping another 4%. It's been straight up ever since NVIDIA came up with their earnings announcement last week. That was the catalyst for the breakout in the semiconductors. We've seen many other semiconductors going up as well. Advanced Micro, AMD has certainly gotten a lift. We've seen some of the semi-equipment companies doing pretty well. KLA Corp, which is KLAC, Applied Materials, AMAT, and so forth. They continue to lead this group to the upside. Texas Instruments, which had has been a relative laggard for a long time. Texas Instruments has been strong since they reported their earnings recently. Finally, I thought I'd give you one that didn't do so well yesterday, and that was the gambling group, falling back below the low that we saw to open May. So new low there, and it looks like it even cleared the low that we saw back earlier in the year. Actually, this was back in December of 2023. So lots of work to do to repair the chart here on the gambling stocks, and it's been a pretty swift fall here over the last 5 or 6 days. All right, moving on to the 10-year Treasury yield. Let me get you an update on this one. Right now, 4.582. Yesterday, we did what I said we needed to watch for, which was a close above 4.53 to 4.54. We actually closed just over 4.54 yesterday. And it looks to me like renewing that move to the upside today is certainly adding to that as we're up another about 4 basis points, 4.58. And I know in futures, let me give you those futures. I didn't give you those earlier. But that was impacting the small cap IWM, as we've come to grow accustomed to. Anyhow, the diamonds right now down 0.7%. This is with about 10 minutes to go to the market open. Diamonds down almost 0.7%. Spider down almost 0.8%. The QQQ down 0.9%, and the IWM down 1.4, almost 1.5%. So futures kind of overnight started getting weak. They've been getting weaker and weaker this morning, and looks like we're going to be off to a little bit of a rough start at the opening bell. We'll see whether or not semiconductors and some of the areas that are helping the market, even some of those materials groups like the non-ferrous metals, aluminum, some of those areas have been doing better. We're now seeing crude oil prices moving off the recent lows, so maybe energy. What we're looking for here is if we do see weakness in technology, communication services, and those types of areas, financials and industrials already have been rolling over. If we start to see more of that, does the money completely leave the market, or does it simply rotate into some of the other areas? And do we see strength in those areas that help the S&P 500 hold up and not fall far from their recent all-time high? That would be a big question for me during any pullback when you're in a move to the upside. Is the money rotating, or is it simply coming out of the market? That's something to look for over the next couple of days if we do see continuing weakness. All right, S&P 500, there was a big red candle. I'll zero in on it. That was the bearish engulfing red-filled candle. We haven't been able to negotiate that, even on the NASDAQ, which was maybe even more pronounced. We've been rising back up the last couple of days, you can see, but not getting through that red-filled candle yet. Now with futures turning back down and gapping down, what I'd look for initially on the NASDAQ 100, probably on the S&P as well, is that 20-day test. Right now, the PPO is moving straight higher. And the question is, if we pull back, do we hold the 20-day moving average? Normally, with a strong PPO like that, we absolutely would. So that's where I would be looking to the downside. To the upside again, trying to break out above that red-filled bearish engulfing candle from just a couple of days ago. That's what we would need to do to the upside. All right, let's keep moving. Let's go over to the IWM. IWM, there was the cup. We kind of come down for it with a handle, but right now it looks like the IWM would drop about $3 at the open, which would take us back to about 202. That would be below this recent low, back into maybe this gap support area. I would then be looking at on the IWM, the bottom of the gap support would be at 199.92, so right around $200. If that doesn't hold and get a quick reversal, then I think we're looking at those recent lows perhaps coming back into play again, which would be down around the 191, 192 level. So today could be a pretty big day for the small caps. And again, a lot of that depends on where the 10-year Treasury yield goes. I've said, I believe we continue in a kind of an intermediate term uptrend. Short term, we had been downtrending, but that seems to be turning back up. So I think now you have to turn your attention to the intermediate term and longer term on that 10-year Treasury yield, which suggests higher yields. So until something changes that, I think we go with potential of higher yields here, maybe back up to 470 at first, and then see if we get through that level. But if we go there and we do move back through that 470 level, I don't think it's going to be good news for the small caps, which have been underperforming and have historically, at least in 2024, even into 2023, been moving inversely to that 10-year Treasury yield. So I think it's really important to watch to see what's going on with the 10-year Treasury yield. If we get a reversing candle off of this uptrend, that could be a great entry point back into the IWM if you're trading it. But right now, I would say the IWM is under pressure because we are getting that short-term breakout again on the 10-year Treasury yield. Transports, not really much to add to what I've been saying. This again, I would say is one of the more bearish looking charts, especially on the daily chart. Breaking down below about 14.8 would be a problem. As we moved up back in November, our first pullback was to about 14.8 off the 20-day moving average before moving up. But quite honestly, this should not have gone back down below about 15.2 to 15.4. It did that at the end of April, and after a rebound, it's doing it again. So this doesn't look good. Transports absolutely do not look good. And I would say this is one of those check marks in the bears columns. If you're putting the pieces of the puzzle together, I can't really look at this and come up with too much bullish to say. And that's really where I've been for a while on this group, probably since the end of March, when it looked like we might be making a breakout. And since then, we've just turned around, rolled over, and putting in lower lows, lower highs. So let's watch that 14.8 level on the transports. Chart of the day. First of all, if you're new to Earnings Beats, welcome. If you're new to the video, please like the video. Hopefully you like the video. And subscribe to our channel. We'd love to have you. If you want to learn more about Earnings Beats and the way we approach the market, scroll down and subscribe to our free, 100% free Earnings Beats Digest newsletter. It's 2 paragraphs in a chart, comes out 3 times a week, Monday, Wednesday, Friday. I think you'll learn some things. I try to make it educational, and I also try to provide stocks that you may want to trade if you're a short-term trader. So you may find some use and value in that. Anyhow, name and email address is all it takes. You can unsubscribe at any time. And again, no credit card required. So you can simply sign up and begin receiving that on Friday. Want to try the service, our paid service? There is a 30-day free trial. That's a lot longer than most companies give you. We want you to come in and experience what we have to offer. We do offer a lot, and that's why we give you 30 days to kind of get around, hopefully experience everything, see what you like. Maybe it doesn't fit your style. That's completely up to you. But if you check it out now and you like it, we are running our spring special through Sunday. We are down to just 4 more days. Members, if you haven't extended, be sure to do so by Sunday, June 2nd at midnight. If you click on this link, it'll just take you to a page. It'll give you more information about the services we offer and also the actual deal itself. And the longer you extend, the more free time you get, all the way up to extending for 3 years. We have a lot of members actually that do this to get a full year free. So you buy 3 years and you get that fourth year free. It brings your monthly cost way, 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 way down. So check that out. Again, this is our best deal, absolute best deal of the year. You will not find a better offer than what we're offering right now. So check that out. Again, you can do that by starting a 30-day trial. And if you do like it after a few days and you say, hey, I want to extend, we will extend you at the end of your 30-day trial. You don't lose the rest of your 30-day trial. All right, chart of the day, MRC Global. You can see the breakout here above the prior April high. We're coming back down. We're testing that prior high, and we're also testing the 20-day moving average. So this could be a stock that would bounce up, of course, with red futures this morning. Let's see where everything starts, whether or not the market rebounds off of these initial lows or if the selling intensifies. If the selling intensifies, probably wouldn't be adding anything until I feel more comfortable that the market's settling down, starting to turn back to the upside. But anyway, this is an interesting chart. These are the types of charts that I would look for. Price support first coming in right at about the 13 level, maybe just a little below. And then you have gap support, which is probably back at about 1230. So watch that. Last thing I want to mention here before we get going, tried to really speed through this. I wanted to show you the difference between the PPO and the MACD. So the PPO, which is the percentage price oscillator, and then you've got the MACD, which is the moving average convergence divergence. They're very, 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 very similar. And what I've done on this chart is I have Apple weekly going back 40 years. And I wanted to show you where you can actually see the difference in how the PPO and the MACD work. So on the top here, I have the PPO, which shows you the price percentage difference between the two moving averages that you're using for the PPO. So normally the 12-week and the 26-week, that's the default for the PPO and for the MACD. So what you'd be looking at is the percentage difference between those two. When you pull up the MACD, it's the dollar difference between the two. So in the short term, like if I pull up a 1-year chart here on Apple, and let me throw that MACD in here. So if we do this, you can see it almost looks exactly the same, right? I mean, if I'm looking at the PPO and the MACD, I don't notice a single difference. It's like, there is no difference. You can use either one, right? Well, here's one of the differences. If we're looking at this on a weekly long-term chart, in a stock that has changed price considerably over the years, like in Apple, look at the dollar difference on the MACD now. Can you compare that to where we were 40 years ago? I mean, can we look at and to see historically whether the momentum is about the same as it was back, when we were trending up, let's say when we were trending up in 98 or even back in 86, 87? There's no way to compare because it's based on the dollar difference. Well, Apple right now is a $190 stock. So the difference between your 12 and 26 week moving average on a $190 stock is not going to be the same when you have a 15-cent stock, which is what Apple was the equivalent of back in 1986. So it's showing the difference between the stock when it was trading at 15 cents. It's probably the difference is going to be in, percentages of a penny. So you can't compare MACDs. Look at the PPO, resolves all that. The PPO, you can look back and see when Apple was soaring back in 86 and 87, look at the PPO. It got up to almost 20. Here, back in 98 and 99, got up to almost 20. Here in 2004, it got to 20. Right now, we're at, 0.62. Why? Because Apple's not really been going anywhere. It's been going sideways, so it's pretty flat in terms of momentum. But when it gets going, you can go back and look to see historically if you're getting close to maybe peaks in momentum. And so that's a big difference between the two for me. And that's one of the reasons why I like to stick with the PPO. The other reason would be if you're comparing two different securities. Well, Apple being a $200 stock, if you tried to compare that to Plug Power, which is a $3 stock, you can't do it with the MACD. Again, you're talking about a high dollar stock and a low dollar stock. The dollar difference is going to be way off. Percentages, though, don't matter. So you can compare the strength, the momentum of Apple versus Plug Power using their PPOs. Anyway, those are that's the key difference between the two. And for the most part, it won't matter. So most people using the MACD and the PPO, it's interchangeable. Just wanted to point out the differences because if you're not aware, I think that is a big, big difference if you're looking at the history of a stock and you want to know what the momentum today looks like relative to its history. Can't do that with the MACD. Anyhow, let's take a quick look, see how this market opened. I'm sure down based on futures. The Dow down 381 points. We've seen a number of these, and we're down. I mean, if we get down to about what it would be, 2,500 points, I guess, to get, we would need 400 points to get to 10% correction. So from 40,000, we'd have to go all the way down to 36,000. We're at 38.4 right now. Get down to 38, that would be about a 5% pullback. And that one definitely has pulled back much more than the other indices. S&P 500, though, down 0.75%. NASDAQ down almost 0.75%. Let's zero in here so you all can see this a little bit better. Small caps down 1.23, almost 1.25%. VIX jumping 10% today, back up over 14. Still low historically. I wouldn't be, jumping, too quickly for the exits based on a 9% move in the VIX when it's simply sitting at 14. We've seen that many, many times in the past, and many, many times it's been a mistake to do that. But at least for now, we are seeing volatility pick back up again, and clearly market having a little struggle here in the morning. But is it a gap down in continuation of selling all day? Is it a gap down, a little bit of morning weakness with an afternoon rally? All of that still left to be determined. One last thing. We do have our live trading room coming up in about 25 minutes. Hopefully the glitch that we had at the beginning of the show, we won't resurface again. I think we're okay for right now. But anyway, let's hopefully see you all in about 26 minutes. And we'll take a look at what's going on in the market, try to decide if there are some trades out there worth it, or maybe if we just want to sit back and watch, maybe do some stalking, get some stocks ready for trades, but maybe wait to see if the market can rebound. Anyhow, that comes up at 10 o'clock. Members are invited. Use that free trial to come in if you're not already a member, and join us at 10 a.m. Eastern. Have a great day, everybody. Happy trading.